In this video, we're going to explore the dark secrets of technical analysis that nobody talks about. When I say that nobody talks about that, I really mean it. This title is not supposed to be clickbait or hype of any kind. Before we begin, let's make an important distinction. Technical analysis is not the same as price action analysis, even though there is some overlap between the two. Technical analysis is the use of modern technical indicators like moving averages, Bollinger Bands, MACD, RSI, parabolic SAR, and etc. to give you trade signals. Price action is the pure analysis of price without indicators, or at least the analysis of price without the lagging element of indicators. For example, the interpretation of candlesticks, the development of line work in the chart, supply and demand, and the overall understanding of market context. There are good modes of using technical indicators in such a way that avoids the major problems I'm going to talk about, but for the most part, technical indicators are a bad thing. Most beginner traders embark on a journey to find the holy grail of technical analysis when they first get in touch with the idea that you can plot an indicator on a price chart to generate simple buy and sell signals. That idea is overwhelmingly attractive for obvious reasons, especially if you are a beginner with not much experience under your belt. I can tell you right now that there is no such thing as the holy grail of technical analysis. You can find the most powerful secrets of technical analysis in the playlist I left in the YouTube card. This is what I was able to find after 13 years of studying these things. Hopefully this playlist will satiate your curiosity and then you will start looking for the things that really matter. The first thing that beginners and some advanced traders should understand is that technical analysis and the technical indicators attract you for simple reasons, but the problems that they hide are not so easy to understand. That's why most people never end up getting these problems I'm going to show you in a moment. Such problems only become clear when you study more serious subjects like econometrics and quantum physics. The pernicious thing here is that you cannot learn the problems of technical analysis if you don't step outside of it, which is the problem of all pseudosciences. So that's what I'm going to do in this video. I'm going to show you the dark secrets of technical analysis from a different perspective. And since it's not my goal to depress you, I'm also going to show you a silver lining. The first problem we are going to talk about is a prelude to the second problem in a way. So pay close attention, as this is important for you to keep learning the other stuff. The first problem is that what you see on a price chart is just the tip of the iceberg of a market. When I say the tip of the iceberg, I do mean the very small 1 millimeter tip of an enormous iceberg that goes miles below water, metaphorically speaking, of course. What I mean by that is what you see on a price chart is the final representation of a market. It's the graphic representation of price. You are not seeing the thousands of variables that make price move. What I want to get at with this statement is that price charts are incomplete sources of information. Price action analysis attempts to go around this problem in smart ways, but technical analysis makes this problem a little worse than what it needs to be. This leads us to the second problem of technical analysis, which is the blind and meaningless processing of price information. What all technical indicators do is to take raw price information, which you can see on the chart, and then apply a mathematical formula to process this information in some way, and output the result on the chart itself or in a separate window. There are three problems here. The first relates to the mathematical formula themselves. Most of the formulas using technical indicators make absolutely no sense whatsoever. If you take any mathematical formula and apply it on the price information, the output would be a technical indicator that appears to make sense, but in reality it doesn't. The second situation is that with technical indicators, the trader must choose a fixed period or fixed window of time for the technical indicator formula to be applied. And that is also something that makes no sense. For example, why would you choose a 20-period moving average instead of a 10-period moving average? If you really think about this, you see that the answer is not clear at all. If price action behaved in a linear way and price movements were always the same length in both axes, then the technical indicators would work like magic. But price behaves in a non-linear way. What I mean by that is that the magnitude and time duration of price vectors change all the time, and they change in a non-linear and unpredictable way that technical indicators are simply not capable of capturing. The end result is that a 20-period moving average will work in some market situations, but it will fail in a lot of others. And that's the case with any indicator period you can possibly imagine. The problem is, how do you know which indicator period to use now? The answer is that you not only don't know, but you cannot know due to the nature of price. The third situation relates to what I said in the first problem. Price is the tip of the iceberg, is the final representation of a market, and the little details and nuances you can find in raw price action say a lot about a market if you know how to analyze them. However, technical indicators purposefully destroy these nuances by processing price through a mathematical formula that has nothing to do with price. In other words, a technical indicator will take price, erase the details and nuances, and then plot that on the chart to show buy and sell signals. What happens is that technical indicators take the little information that price charts have, and they make sure this information is ironed out, flattened, and stripped out of its meaning. In the attempt of making price action less noisy, technical indicators destroy the very elements that will allow a trader to extract useful information out of the chart. The meaningful information is in the noise, but the problem is that most traders don't know how to see the order within chaos. The third problem is actually known, and is the problem of lag. However, even though a lot of traders are aware of lag in technical indicators, they don't know why it happens and what you can do about it. Lag is also the result from the stuff we just discussed. When you condense price information through a formula given a fixed time period, it will decrease the noise in price, but you will do that at the cost of adding lag. This is called the lag-noise trade-off. If you decrease noise in price by using a larger period for the technical indicator, you will increase lag. If you decrease lag, you will increase noise. There's a mathematical trick that can be used to decrease lag, as you can see in the video about moving average secrets, but that still doesn't solve the problem of a linear indicator periods being applied to nonlinear price vectors. By the way, using a linear tool to solve a nonlinear problem is like using a screwdriver to paint a wall. It's the wrong tool for the job. Given these problems, you should be able to get that technical indicators will make the incomplete information available in price charts even more incomplete. Extracting good information out of a price chart through high-quality price action analysis is already difficult. If you use technical indicators in the way they were built for, you'll be basically shooting yourself in the foot. Before we move on to the basics of econometrics, which will really help you understand the problems of a price chart, let's summarize what we have. We know that price charts are incomplete, and they are the tip of the iceberg when it comes to the information about a market. Technical indicators will make that problem even worse by taking linear portions of price action and processing them through a meaningless mathematical formula that produces lag. The application of linear periods on nonlinear price vectors is obviously inappropriate. Let's now move on to the basic principles of econometrics, which will hopefully shed some light into the problems that most traders don't know they have. Econometrics is the alignment between economics and mathematical statistics. Economics will teach you how economic forces work in a qualitative way, meaning that it will teach you how economic variables work without showing how to measure or forecast them. In econometrics, we have the quantitative approach of economics. The simplest example of this is that the sign of economics will tell what variables affect the GDP, for example, while econometrics will give you tools on how to measure and forecast the GDP in light of the theory laid out in the qualitative aspect of economics. Econometrics is very broad, but the part of it we are interested in is called the econometrics of financial time series. In other words, the science that explains how to measure and forecast the price of financial instruments. To make a provocative analogy, technical analysis is to econometrics what astrology is to astronomy or alchemy is to chemistry. Technical analysis is a pseudoscience. Econometrics is a real science. The useful thing about it is that we can take a price chart, or a time series as we should call it, and strip it down into its most basic elements. After that, we can truly analyze what's going on. I don't have the audacity to create a course on econometrics in a short video, but I will show you some interesting ideas. The first interesting idea in econometrics is the idea of stationarity, which is a fundamental concept for those who want to predict what's going to happen with price in scientific terms. Stationarity relates to the mean of a time series. If a time series has constant mean, it is said to be stationary. For example, a sideways market is stationary because it oscillates in lateral motion. However, most time series in finance are non-stationary, which means they have variable mean. This is basically the idea of trend. If you take the price of a stock or the price of a currency, for example, you see that it has different trends all over the place. The second interesting element of financial time series is the stochastic element, which has nothing to do with the stochastic indicator, which is pretty much a mathematical joke. Stochastic means random. We have basically two types of time series, the stochastic and the deterministic. The deterministic time series are those who have a very orderly behavior and can be completely modeled using a linear function. The stochastic time series is random, meaning that it has random shock built into it, and therefore an element of uncertainty and noise. All financial time series are stochastic because there are many unknown variables acting on price at the same time. The third important element of time series is called heteroskedasticity, which relates to the variance of a time series. Heteroskedasticity means that the variance of a time series changes, meaning that volatility, which is the same as standard deviation, which is the square root of variance, expands and contracts over time. This is a phenomenon called volatility clustering, which is another component that makes it difficult to deal with financial time series. Now add these three elements on top of each other and you have a price chart. A non-stationary, stochastic, and heteroskedastic time series, which is the worst and most difficult time series to analyze and forecast by the light of the techniques found in econometrics. One thing you have to keep in mind is that econometrics is a science, so all of these components can be measured mathematically, which means objectively. There is no such thing as looking at a chart and making subjective judgments about the market like in technical analysis and price action analysis. At this point, you might be asking yourself which techniques and methods you can find in the science of econometrics that will help you make better trades. The answer to this question is that there are many different approaches, since the most basic one until the incredibly complicated ones. In this video, I want to spark your curiosity about one of the simplest and yet most powerful and also most used econometric techniques to trade the markets. We are going to use what we saw so far in the video to have an idea how this technique came to be and why it's so powerful. Just so you have an idea of how serious this is, there are many funds out there that use this method as a main strategy, and the idea behind the strategy earned a Nobel Prize in economics. The strategy I'm talking about came from a concept called cointegration, and it solves a major problem found in financial time series, or as most of us are used to, it solves a few problems in price charts. As we saw before, the issue with price charts is that they are non-stationary, meaning that they have a variable mean or trends all over the place, and they are stochastic, meaning that they are random. By the way, random doesn't mean unpredictable, as we'll see in a moment. And the third problem is heteroskedasticity, or volatility clustering, meaning that the variance of a financial time series expands and contracts across time. In very rough terms, the cointegration method takes two different non-stationary time series, or two different price charts, and it creates a linear regression between the two. If you end up studying econometrics in greater detail, you will see that linear regression is a cornerstone in this science because of its simplicity and robustness. If we create a linear regression between two non-stationary price charts, and the residual from the linear regression is a stationary time series, we can create an arbitrage strategy with these two markets that is incredibly simple and easy to apply. In more basic terms, what the cointegration technique does is to extract a sideways market from two different trending markets through a linear regression. That's the basic intuition behind the method. Of course, there is a lot more to it than that, since econometrics there is a specific way to measure all variables. The advantage in all of this is that a sideways market is very easy to trade. Once price is above a certain level, you sell, and once it is below a certain level, you buy. When you eliminate the trend components of a time series, things become a lot easier to deal with. The problem with trends is that they change all the time, and there are trends of different magnitudes layered on top of each other. In summary, Cointegration eliminates the unpredictability of the trend component, and it also deals with the Heteroskedastic component of time series. In other words, the stationary time series extracted out of two non-stationary markets will have constant mean and constant standard deviation. The interesting thing is that cointegration doesn't deal with the stochastic component of a time series, and that begs the question, if a time series is stochastic, meaning that it is random, how can cointegration make it predictable? We should understand that random doesn't mean unpredictable. The advantage in a stationary time series that is also stochastic is that the series is random, but it's random between a predictable range, which makes it predictable in the end. Let's make a simple analogy so you understand what this is all about. Imagine a drunk person walking down a straight street. You cannot predict the exact path that the drunk will take, but you can affirm with good certainty that the sidewalks are the boundaries and he's going to oscillate between them. That's more or less what cointegration does. This idea is almost a utopia for those who have struggled with trend trading. The idea that you can always trade a sideways market is almost too good to be true, but in this case it is true. This is why cointegration earned a Nobel Prize in economics. Clive Granger received the prize in 2003. Unfortunately, he passed away in 2009. You can watch his Nobel lecture about cointegration on the Nobel Prize website. Don't worry if you are confused about all of this because econometrics is not exactly easy. If you want to learn more about this trading method, I wrote an entire ebook about it called Statistical Arbitrage by Cointegration. In this ebook, I try to explain how this methodology works in the simplest way possible, which is not something you will find in the literature about econometrics, which tends to be filled with too much mathematical notation, and it is a bit difficult to understand if you don't apprehend mathematical statistics. That's the problem that my ebook attempts to solve. So if you have interest in it, go to my website fractalflowpro.com and then to the ebooks category, and you'll find a table of contents of the ebook. That's it for this video. I hope you learned something new and useful with this video. If you like the material I create, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, and leaving your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.